This is the 60/40 portfolio your advisor will not tell you about. I am Trace Halverson and I like to talk about Bitcoin. Don't know if you've heard, especially if you know me. The 60/40 portfolio, your financial advisor loves it, your parents probably have it, and it's quietly bleeding you dry. Here's the reality. The financial landscape isn't just changing, it's already changed. The old playbook is obsolete. Traditional investment methods are failing because of one relentless force: inflation. Today, we're exploring what happens when you rebuild the traditional 60/40 portfolio with Bitcoin as the foundation. Not because it's trendy, but because the math actually works.
This is not financial advice. This video is for financial education and entertainment purposes only.
The picture on this slide sums it up perfectly. It shows how $100,000 worth of purchasing power breaks down over the span of 30 years. The average savings rate is around 4%, but the average rate of growth for the US dollar is 6.6%. So while on paper it looks like your portfolio is doing great, earning a measly 4% per year, you're actually losing 2.6% of purchasing power because you are failing to beat the supply growth of dollars. So here's the illusion. It looks amazing on paper, right? After 30 years of earning 4%, your $100,000 is now worth $325,000. That's amazing. However, even though it's grown nominally, the amount of purchasing power you once had with $100,000 30 years later can now only buy $47,000. So on paper, it looks like you did great, your number went higher, but in real life, you actually lost and you can buy less and less now. Let's start with a stat that should make you feel uncomfortable. 90% of all stocks in America are owned by the top 10%. The bottom 50% of Americans, they own just 1% of stocks. The middle class didn't shrink, it disappeared. There are now two groups: people who own assets and people who do not. Which group are you in? And more importantly, which group do you want to be in 10 years from now? Here's where it gets fun. Let's play a game called Guess the Growth Rate. I have to give credit to Adam Livingston for using this comparison because it is both hilarious and very haunting. From 2016 to 2025, the average American wage grew from $48,000 to $66,000. That's a 37% growth over 9 years. It's not amazing, but it's not terrible either. Now, in that same period, a fast food pink slop chicken sandwich from McDonald's went from 99 cents to $4.59. That's a 364% growth in your McChicken. Your wages went up 37%. Your McChicken went up 364%. You're not bad at math. The system is rigged, and this is not an accident. The US national debt just crossed $38.4 trillion. If we divvied that up amongst all American households, you would owe $286,000. Congratulations! But wait, it gets even better. In 2025, we paid $1 trillion in interest alone on that debt. That's more than what we spent on the entire defense budget. The, the US military, the entire defense budget, the interest payment on our debt alone trumped that. So how do we pay for it? Well, we don't. We borrow more money and we print more money, which creates more inflation, which requires more borrowing. It's the world's most expensive merry-go-round, and we all pay for it. Lucky. We're so lucky us. The M2's money supply is now $22.43 trillion, growing at around 6.6% per year. The M2 money supply is just another fancy way of tracking the amount of dollars that have been printed. Here's the problem. Not a single traditional fixed income investment beats 6.6%. High yield corporate bonds get close, but they're only 15% of the entire fixed income market. The rest, US Treasuries, over $38 trillion worth, and they're yielding maybe 4% while inflation runs at a true around 7%. Your portfolio might say it's going up, but your purchasing power is certainly going down. You're winning the game, but you're losing in real life. This puts the Federal Reserve in what I like to call an elegant trap. You have two options. Option A, keep rates high, fight inflation, but make the national debt impossibly expensive and risk tanking the economy. Option B, lower rates, print more money, keep things moving, but fuel more inflation and basically admit you're bailing out government spending. Clearly, there's no good choice here. They're picking between bad and worse, and me and you are stuck with the consequences either way. So let's talk about everyone's favorite retirement strategy, the 60/40 portfolio. 60% stocks, 40% bonds. Simple, balanced, boring. Perfect, except it's broken. Money supply grows 6.6% annually. The 60/40 portfolio averages about 8% returns. Cool, you're up 1.4% in real terms, barely beating inflation. Then 2022 happened. Their portfolio lost 17.5%. Stocks down 18%, bonds down 13%. They both tanked at the same time, the exact scenario they weren't supposed to do, highlighting the fact that everything has risk. Going outside has risk, drinking water has risk, eating chicken has risk. Everything we do in life has risk. 8% return sounds great until you realize the dollar is losing value almost as fast. You're essentially Usain Bolt stuck on a treadmill going 6.6 miles per hour. Okay, so here's the obvious problem. Treasury yields around 4%, real inflation around 7%. Your net return is a negative 3% annually. Your safe bond allocation is a guaranteed way to lose money slowly. It's safe the same way a melting ice cube is safe. But here's the good news, and yes, there is good news. Bitcoin offers an alternative, digital, decentralized, and most importantly, scarce. It's money that exists outside the system of sovereign debt and monetary policy, which is controlled by an anointed, hand selected few. Think of it as an exit door out of a burning building. Everyone else is stuck looking at the smoke, wondering, like, what are we going to do while you're looking at the door? So, what makes Bitcoin different? This is where I want to emphasize that this strategy is not built on the dollar collapsing. This strategy isn't built on governments collapsing or any other conspiracy you've heard another Bitcoin maxi talk about. While there's merit to some of the arguments, this strategy is built by math and the simple fact that governments and central banks around the world are going to continue printing money. So, with that being said, let's talk about three specific things that make Bitcoin different from government issued dollars. One, fixed supply. There are 21 million Bitcoin. That's it, forever. No CEO, no dictator, no president, no king, no central bank, no Federal Reserve. No one can ever change that. It's mathematically impossible. There will never be more than 21 million Bitcoin. And as a matter of fact, roughly 19.9 million Bitcoin have already been distributed, which is roughly 95.13% of the supply. So let's go into how they're distributed. Two, capped issuance. Every 10 and a half minutes, 3.125 Bitcoin are distributed. In 2028, that drops to just 1.56. In 2032, it drops down to 0.78. You tracking here? So every 4 years, the amount that's distributed every 10 minutes is cut in half. All the way until the year 2140, when the last Bitcoin is mined, and that's the end of the story. That will be the 21 millionth Bitcoin distributed, and that is the supply that will be traded forever. With that said, let's talk about a market determined price, better known as a free market. There is no Federal Reserve, there are no interest rate decisions. This is purely global supply and demand, global buyers and sellers constantly setting the price 24/7, 365. This is what an actual free market looks like. But Trace, isn't Bitcoin just for libertarians and people who live in their parents' basement? Well, yes, it's obviously for them, but it's for everyone also. And what I like to say, and what my father-in-law likes to say, is the people who need Bitcoin own Bitcoin, and the people who don't need Bitcoin don't own Bitcoin. It's as simple as that. I'd be willing to argue that if we keep progressing the way we're progressing, everyone is going to need Bitcoin. So the people who adopt it the earliest will benefit the most. Anyway, publicly traded companies are stacking Bitcoin on their balance sheets. Governments are adding it to their reserves. Major banks, the same ones that called it a scam 5 years ago, now offer custody and accept it as collateral. These are the same banks that were saying, oh, it's only used for terrorism and every bad thing you could think of under the sun. And they've now literally flipped, and now they issue ETFs. They allow Bitcoin to be used as collateral, and they offer custody services. So that's a pretty strong 180 if you're asking me. So yeah, this isn't fringe. This is quite literally Wall Street putting its money where its mouth is. Bitcoin's institutional adoption represents a fundamental shift in legitimacy. It's increasing liquidity, reducing volatility, and integrating into conventional portfolios. This isn't speculation anymore. It's a structural change in how sophisticated investors think about wealth preservation. And if you're watching this, you're still early, unbelievably early. All right, let's get into the good stuff here. The 60/40 portfolio backed by Bitcoin. Here it is. 30% is going to be directly in Bitcoin. If I had to suggest anywhere to buy Bitcoin, it would be River. 20% of the portfolio is going to be in strategy. The ticker is MSTR. They hold 687,000 Bitcoin worth around $65.7 billion, and they raise additional capital to buy more Bitcoin by issuing fixed income products. Strategy has its own reflexive flywheel where every time they raise money, they buy Bitcoin with that money, and then it makes their company more valuable, and then they're able to raise more money again, and then with that raised money, they buy more Bit. Like, it sounds crazy, but it's quite literally the strategy they've perfected and they're executing. And it's allowed them to be the largest corporate holder of Bitcoin. It's allowed them to be the largest holder of Bitcoin in the world. All right, 5% of the portfolio is going to be in Strive. They are executing the same exact strategy as Strategy, no pun intended, and their ticker is ASST. They're smaller, they have zero debt, and they are primed to explode it with growth. Now, 5% of the portfolio is going to be in Metaplanet. Metaplanet is the Japanese version of Strategy. They are offering the same types of products Strategy are offering, except for the Japanese financial markets, and they own around $3.35 billion worth of Bitcoin, which is around 35,000 Bitcoin. These aren't your typical crypto companies. These are the largest Bitcoin treasuries in the world that have perfected a strategy that allows them to accumulate Bitcoin faster than everyone else. It's crazy. Now, for the income side, this is where it gets interesting. We're going to put 20% in STRC. STRC constantly trades around $100 per share. It yields around 11% annually, paid out in monthly tax deferred dividends. You heard that correctly. This is fixed income that is tax deferred that pays you monthly. The target range is around $97 to $99. We'll explain this in a second. The final 20% of the portfolio is going to be in SATA. It's roughly the same exact thing as STRC, except it yields higher and the target range is a little higher because SATA is the product from Strive. Strive is it's a smaller company, so the risk profile is different with STRC and SATA because STRC is backed by a company with nearly 700,000 Bitcoin, and SATA is backed by around 13,000 Bitcoin. They are still well over collateralized, and they are still both going to be very successful products. Okay, this sounds too good to be true, but let me tell you why and how it works. So when these instruments trade at $100 per share or more, it allows Strive and Strategy to then issue additional shares, basically sell shares to the open market so that the price of these instruments fundamentally falls below $100, but then in return, the company raises more money to buy more Bitcoin with it. So while these companies buy more Bitcoin, their credit instruments seem more safe. So then more people want to buy it, and then it naturally brings the price to $100. Well, okay, Trace, what happens if the price starts falling below and people aren't buying it and it's having a hard time getting back to $100 per share? These companies can then actually increase the yield on these products to make them seem even more attractive to investors. So no matter what, these companies can make adjustments to make sure that these prices can stay stable and that they can also continue to raise additional capital to buy more Bitcoin with it. Let's run the numbers. And I'm being deliberately conservative here because I'd rather underpromise and overdeliver. Let's look at it on a 10-year horizon. Bitcoin grows at 20% annually. That's about a 6.19x multiple. For context, Bitcoin's actual annual average return from 2015 to 2025 was 74.6%. We're using less than a third of the historical performance. We are also assuming that MSTR, Strive, and Metaplanet track Bitcoin at exactly 1x. No premium pricing, no additional accumulation, even though the market has historically given the Bitcoin on these balance sheets a premium, and even though these companies have aggressively and will aggressively continue to buy more Bitcoin. STRC and SATA compound at 11% and roughly 12% respectively. So this is not a best case scenario. This is the most conservative base case reasonable scenario possible. With these conservative assumptions, your capital grows 4.94x in 10 years. If you pull cash out along the way without reinvesting dividends, you still get 5.4x total returns. You are generating tax deferred income, your Bitcoin never gets sold, there's no leverage, there's no wild assumptions, and there's no hoping for miracles, moonshot, we're going to the moon. This is just math. Here's the best part. The 60/40 split is a starting template, not a prison sentence. Need income now? You can weight heavier toward STRC and SATA. Want pure growth? You can go 80/20 or even 100% direct Bitcoin exposure. Some investors need their portfolio to fund their lifestyle. Others are building generational wealth and won't touch it for decades. This structure flexes to fit your actual life, not some financial advisor's one size fits all portfolio or model. If you've made it this far, congratulations and thank you for listening. You are early. I cannot stress enough how early you are, not because you're gambling, but because you're paying attention. This isn't a Bitcoin strategy built on conspiracy theories, leverage, our number go up, hopium, or we're going to be Lambo bros, wins the moon. But it doesn't require a government to collapse or the dollar to disappear. It is built on one simple premise. High sovereign debt forces low real rates. Low real rates make hard, scarce assets valuable over time. Bitcoin is the hardest asset to ever exist, and it expresses this reality better than anything else available in financial markets. The result is a risk aware, rules based strategy that's intentionally simple. It's designed to let inflation work for you instead of against you, because we can all agree that inflation is just going to continue to get worse. And like this presentation talked about, there's two options. And option one means that there is a complete financial breakdown, and option two means they just have to print more money to keep the game going. We all know that they're just going to keep printing money. So please, if you made it to the end of this video, thank you so much. Please like, comment, and share. Help me spread the Bitcoin word. If you want to connect or go deeper on any of this, email me at trace@element1.ai. Find me on X at trace_Halverson, or visit getorchestrator.com to check out our AI business. Now go build a portfolio that actually works in the world we're living in, not the world we wish we had. God bless you all, and we'll talk to you next time.